Today's video will delve into the best chip stocks to buy after Nvidia's stock split. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. Nvidia shareholders had nothing to worry about. After the company implemented a 10-to-1 stock split, Nvidia shares ended the day up by over 1%. A shareholder who previously held 10 shares now holds 100 shares, with each share priced around $121. This positive outcome post-split raises an intriguing question. What other chip stocks should investors consider after Nvidia's split? Let's explore some potential opportunities that might benefit from similar market perceptions and technological advancements. For comparison, this new price makes Nvidia stock cheaper than its main competitor, Advanced Micro Devices, which is currently priced at $160 per share. With a lower price tag, Nvidia is likely to attract more investors, even though its price-to-earnings ratio of 73.26 suggests it might be overbought. The broader AI semiconductor market is still in its early stages. JP Morgan PB equity strategist Bruno de la Sota noted that this is a multi-year opportunity that is just beginning to impact corporate earnings. While Nvidia continues to dominate this space, let's look at other chip stocks to consider. Number 1. ARM Holdings, ticker ARM. A British chip designer offers an exciting opportunity. Instead of manufacturing chips directly, ARM licenses its CPU and GPU designs to other companies. This strategy has given ARM a dominant market share in the embedded computing and mobile app segments, with 65% and over 90% shares, respectively. This royalty-based revenue model has significantly increased ARM's market cap to $163 billion. Recently, ARM's leadership expressed greater ambitions. They aim to capture over 50% of the Windows PC market, which is currently dominated by Nvidia, AMD, and Intel, within the next 5 years. ARM CEO Rene Haas believes this is likely due to Microsoft's shift towards ARM-based chips to compete with Apple's offerings. At the Microsoft Surface Copilot Plus presentation, Qualcomm's Snapdragon X Elite and Plus chips, based on ARM's design, were showcased. This trend benefits ARM shareholders as more vendors like Dell and Asus adopt ARM-based machines. By the end of 2025, ARM expects 100 billion devices to power AI applications. Recently, ARM's stock was up 36% to $155.59, a 74% increase over its 52-week average of $89.37 per share. ARM Holdings has a strong foothold in the mobile and IoT markets, with their chips powering a significant portion of smartphones and other connected devices worldwide. This widespread adoption is driven by their efficient and powerful designs, which are crucial in today's energy-conscious tech landscape. Additionally, ARM's move into the automotive sector with their processors for autonomous driving systems and advanced driver assistance systems, ADAS, positions them well for future growth. Why should you consider investing in ARM Holdings? Well, they have a massive market share in mobile and embedded computing, meaning they're pretty much everywhere in these spaces. Their royalty-based revenue model is like a steady income stream, giving them a reliable financial foundation. Plus, they're not just sitting still. They're expanding into new markets like automotive and AI, which could mean big growth down the road. However, they don't make their own chips, so they're dependent on other companies for manufacturing. There's tough competition from big names like Intel and Nvidia, especially in those new markets they're eyeing. And let's not forget, the stock market can be volatile, and that can impact ARM's stock performance. Now let's take a moment to consider some questions. What do you think about ARM's strategy of licensing their designs rather than manufacturing their own chips? Do you believe their move into the automotive sector will pay off? Share your thoughts in the comments below. Number 2. Micron Technology, ticker MU. Micron Technology recently lost a patent infringement case in Texas, which could force it to pay Netlist up to $445 million in damages. Despite this setback, Micron Technology stock has outperformed the broader market with a 13.4% gain and nearly 100% gains over the past year. This is because Micron is a key player in the memory module market, supplying micro SD cards, DRAM, NAND flash, and multi-chip packages for enterprise solutions. In the high-bandwidth memory, HBM sector, Micron expects to capture up to 25% market share by 2025, competing with Samsung and SK Hynix. Micron's advanced HBM3E technology began production in February, and they are actively developing the next-generation HBM4 memory lineup. For GPUs, Micron's GDDR7 memory offers over 50% energy efficiency improvement, which extends battery life for mobile devices and enhances AI and gaming performance. Even if Micron has to fully pay Netlist, it is unlikely to be a major issue, as the company reported a 57.7% year-over-year revenue increase ending February 2024. Micron Technology stock is currently priced at $140.75, 63% above its 52-week average of $86.13 per share. Analysts have an average price target of $135.98, with an upper ceiling of $224.18 per share. Micron's innovations in memory technology are pivotal for the advancement of AI and machine learning applications, which require large amounts of fast, efficient memory. The company's focus on developing cutting-edge memory solutions positions it well to capitalize on the growing demand for high-performance computing and data centers. Why might Micron Technology be a good investment? For starters, Micron is a big deal in the memory market, offering a wide range of products from micro SD cards to advanced enterprise solutions. They've been showing strong revenue growth and solid market performance, which is always a good sign. Their cutting-edge memory technologies like HBM and GDDR are crucial for the future of AI and high-performance computing. On the downside, they might have to pay out a lot of money due to legal disputes, which could impact their finances. There's also stiff competition from other major memory manufacturers, so they'll need to keep innovating to stay ahead. And let's not forget, the semiconductor industry is cyclical, meaning it has ups and downs that can affect their business. Speaking of innovation, what are your thoughts on Micron's advancements in memory technology? Do you think their focus on AI and high-performance computing will give them an edge over competitors? And how do you feel about the potential financial impact of their legal disputes? Let us know in the comments. Number 3. United Microelectronics Corporation, ticker UMC, a Taiwanese semiconductor company, manufactures integrated circuit solutions for telecom, IT, and multimedia sectors across multinational foundries in Japan, Singapore, China, and Taiwan. United Microelectronics has also invested in renewable energy solutions through its subsidiary, Nextpower Technology, which produces thin-film photovoltaic (PV) found in solar panels. After a slump in net sales during 2023, United Microelectronics turned around in February, showing consecutive year-over-year growth up to May. In its first quarter of 2024 earnings report, the company shipped 4.5% more wafers. United Microelectronics' specialty business offset a minor drop in utilization rate by supplying silicon interposers for AI servers, RFSOI chips, and power management ICs. As a cyclical company, United Microelectronics benefits from the rising AI demand, pushing it into a positive cycle. Ahead of inventory replenishments in PCs and consumer electronics, United Microelectronics is completing a $5 billion expansion of its Fab 12i in Singapore, set for mass production in early 2026. This will be one of the most advanced foundries for 22 and 28 nanometer chip manufacturing. At $8.74 per share, United Microelectronics stock is close to its 52-week high of $8.97 and has remained relatively stable at an average price of $7.75 over the last 52 weeks. Investors looking for chip stocks to buy after the Nvidia split should consider United Microelectronics' relatively high dividend yield of 6.59%, with an annual payout of 58 cents per share. United Microelectronics' investments in advanced manufacturing processes and renewable energy solutions highlight their commitment to sustainable growth. Their focus on producing chips for emerging technologies like AI and IoT ensures they remain competitive in a rapidly evolving market. Thinking about investing in United Microelectronics? Here's why it might be a good idea. United Microelectronics is solidly positioned in the semiconductor manufacturing space, which is crucial for tech development. They've got a strong commitment to renewable energy and advanced manufacturing, which shows they're thinking about the future. Their stock has been stable, and they offer a pretty attractive dividend yield, making them a reliable choice. But keep in mind, the semiconductor industry can be pretty cyclical, with ups and downs that might affect United Microelectronics' performance. They face competition from larger semiconductor manufacturers, so they'll need to stay innovative. Their success is somewhat dependent on the market demand for AI and consumer electronics, which can be unpredictable. What do you think about United Microelectronics' focus on renewable energy solutions? Do you believe their investment in advanced manufacturing will pay off in the long run? And how important is a stable dividend yield for you when considering stocks? Let's discuss in the comments below. Let's take a closer look at the key stats for our top chip stock picks, which give us a clearer picture of their potential. First up, ARM Holdings, ARM, stands out with an impressive year-to-date surge of 36%, pushing its stock price to $155.59, with a market cap of $182 billion and a revenue of $3.23 billion. ARM's stronghold in the mobile and IoT markets is evident. Next, we have Micron Technology, MU, which, despite some legal setbacks, has shown remarkable resilience. Their stock price is at $140.75, reflecting a 13.4% surge this year. With a market cap of $170 billion and significant revenue of $15.54 billion, Micron is a key player in the memory module market. They provide a dividend yield of 0.3%, indicating their commitment to returning value to shareholders. Lastly, United Microelectronics Corporation, UMC, is notable for its stability. Priced at $8.74 per share, UMC's performance has been relatively stable, maintaining a market cap of $22 billion. They have a solid revenue stream of $7.14 billion. UMC also offers an attractive dividend yield of 32.46%, making it a compelling choice for income-focused investors. These stats highlight why ARM Holdings, Micron Technology, and United Microelectronics are strong contenders in the semiconductor market, each offering unique strengths and opportunities for growth. These are some of the chip stocks worth considering after Nvidia's stock split. Each of these companies offers unique strengths and opportunities in the semiconductor market, whether through innovative design, market dominance, or strategic positioning. ARM Holdings, Micron Technology, and United Microelectronics Corporation all present potential for growth and investment returns. Now we have a few questions for you. Which chip stocks are you most interested in? Do you think Nvidia's stock split will influence other companies to follow suit? What factors do you consider when choosing semiconductor stocks? Let's engage in the comment section below and discuss your thoughts. If you enjoyed this video, please like and subscribe to our channel for more content on stocks and investing strategies. Remember, this video is for informational purposes only and does not constitute financial advice. Thank you for watching, and we'll see you in the next video.